I don't think tariffs are going to have much impact on the U.S. economy because we still have such a problem with inflation generally, apart from tariffs, that I wasn't expecting the economy to slow down. I think this economy is going to continue to cause the Fed a lot of problems because they want to find a reason to reduce interest rates. They know that there's stuff going on in the background in commercial credit, commercial real estate, and yet when they look at the consumer, there's no problem. That's the interesting thing.
Chris Whalen, chairman of Whalen Global Advisors, investment banker, author of multiple books, author of the incredible blog, The Institutional Risk Analyst, and a contributor and friend of this show. It is great to see you as always, Chris. Thank you so much for joining us once more for your monthly appearance.
Thank you, Julia. Happy February.
Happy February is right. And I got to say, I was just thinking the other day, like how lucky I feel that I get to talk to you 12 times a year. You're one of our... It's so true. You're one of our favorite guests, and the audience loves hearing from you. And I just feel really fortunate that I get to, spend 30 minutes with you, just picking your brain and hearing, what do you make of everything that's happening? And we're recording on Monday, February 3rd. It's just past 11 a.m. Eastern for folks. We just kind of got a delay on the tariffs on Mexico, but I feel like there's so much happening right now. So can we kind of frame up your picture of where we are? We got to talk about tariffs as well. Like, what do you make of this situation?
Well, Donald Trump has taken us back to the 19th century. We're going to go back to the age of tariffs, which America had for a long time, really going back to the beginning of the country to protect us from European predation. So now, he's taken out that old playbook and he's basically demanding that countries like Mexico deal with some outstanding issues: drug trafficking, violence, immigration. Trump likes to fight. He likes to have people that he can fight with. It's a classic political playbook, right? So he has decided to fight with foreign countries to give him political traction. And the midterm election has already begun. So that's really how I would frame it for you. I don't think it's any more complicated than that. But this group around Trump is moving much more quickly and in a much more organized way than they did the first time around. So that's the major change. And he has quite an agenda. It's really impressive. But he is so far ignoring financial institutions, housing, whole large swaths of the political landscape that he hasn't gotten around to yet. So I think taxes is the big thing for him this year.
Yeah, tax is the big thing. You mentioned, just real quick before we get into these other items, you mentioned that it is a classical playbook. I know you as a bit of a historian too. I mentioned at the top, you're a prolific author. I imagine, is there in Inflated, do you talk about tariffs? I can't recall. I read the book a while ago. Okay. What are some of the maybe parallels? What are some of the misconceptions? I imagine there are a lot of misconceptions you're seeing around tariffs and the narratives. Are there any that are on your radar?
Well, in the period, that we talk about in Inflated, which was really the 1900s into the Great Depression, tariffs were quite popular. They were the, stock and trade of the Republican Party. They didn't want to essentially allow the Europeans to attack American industries. That all changes after World War I, though, because we discover how cool it is to sell the Europeans bullets and clothing and everything else they needed for the war. And that caused the American economy to recover from what had been a difficult period. But right after World War I in 1918, the economy falls flat, especially the farm sector. So the Democrats were always against tariffs. They thought it was bad for the working man. They thought it would promote inflation. And the reality is that the tariffs in the 1930s, Smoot-Hawley, which is iconic in most history books, was really about the agricultural sector. The farm had been going through deflation for more than a decade, and it was a desperate last effort to help farmers, and it didn't help at all. FDR had devalued the dollar in 1933. He had seized all the gold. So, the U.S. was in for a decade of deflation and very difficult times. And I think it's wrong to blame that on tariffs. Tariffs were a factor, clearly. They didn't help. But we had tariffs for 50 years before that.
Yeah. how about the narrative that gets thrown around that they are inflationary? Is that the case?
It can be. It depends. I mean, if you're talking about the Chinese, will they raise their prices if we impose tariffs on them? No, no, not at all. They care about market share. So they will internalize the additional cost of the tariff to maintain market share because that's all they care about. The Chinese in many industries will work for nothing to keep market share. So that's really what's going on.
Yeah. Okay. What about just the general state of the economy? Because the Fed transcripts that came out these were from 2019. They came out last week around the FOMC day. Some pointed out in those transcripts around tariffs that maybe the economy was going to slow down or headed for a slowdown. Do you think, what is your take on just the state of the economy and what tariffs could mean?
I don't think tariffs are going to have much impact on the US economy because we still have such a problem with inflation generally, apart from tariffs, that I wasn't expecting the economy to slow down, even with interest rates where they are. So, think about that. It's kind of counterintuitive. Most people think of where interest rates are now as very, very punitive, very difficult for consumers, to buy a house, credit card rates in the 20s and all of that. And yet the Fed really hasn't reduced the amount of liquidity in the economy. They've been afraid to. Why? Because of the big federal deficit. They want to keep the Treasury market open. So they have erred on the side of liquidity. They didn't even reduce reserves over the past 4 years, Julia. So in a classical sense, did we really have tightening from the Fed to force home prices down, to really impose a little bit of a deflationary bias on the economy? No. I think this economy is going to continue to cause the Fed a lot of problems because they want to find a reason to reduce interest rates. They know that there's stuff going on in the background in commercial credit, commercial real estate that needs lower rates. And yet when they look at the consumer, there's no problem. That's the interesting thing.
Okay, that's interesting. I would love to explore that further because we didn't get a rate cut last week.
Nope.
Do you think, well, one, I'd like to get your reaction to that, but do you think we'll see one in March?
No, not necessarily. There's two factors. One is the data is not supporting a cut. For every data point that we see, Julia, that kind of sort of says, well, the economy is weakening, we have another one that indicates that consumers are ratcheting up spending and ratcheting up overall activity, jobs, hardly in a recession mode. And the other factor politically is that when Vice Chairman Barr stepped down as the honcho for bank supervision on the Fed board, he remained a governor. But he basically said, okay, if President Trump wants to appoint somebody else, I won't stand in the way. But what that does is it makes all the governors circle the wagons and protect the Fed. Even Mickey Bowman, okay, who's a Trump appointee. They're all going to now protect the Fed, and they're going to find reasons not to cut interest rates to show how independent they are. So I'm a little worried about this. We're playing chicken because at the same time, remember, the Fed's been slowly reducing the size of the balance sheet, letting Treasury bills, letting mortgage-backed securities run off. We don't really know what the minimum level of liquidity is in the market before we have another problem, like the end of 2018. And I think that, to me, is the big question mark. In other words, the Fed is trying to prove how independent they are, but at the same time, I think they know that we're getting pretty close to the floor when it comes to liquidity in the market, largely because of the federal budget deficit and the public debt. We create $1 trillion worth of new debt in this country every 4 months.
Yeah. Okay. You piqued my interest there on this kind of notion that we're playing a game of chicken. Can you put some more meat on the bones? Like, walk us through this, this kind of issue and the fiscal side of it as well. Just flesh it out for us a bit more. For maybe folks who are like myself, I'm much more of a layperson, but I want to hear a bit more on this.
The Treasury keeps their cash at the Fed. The Fed actually keeps it in an account called the Treasury General Account. So when they go out and sell a lot of bonds every quarter, they raise cash, the cash goes into the Fed, they then spend it. So as that money leaves the Treasury's account at the Fed, it goes into banks, and it helps the economy, obviously, right? That's one part of it, just the ebb and flow of the Treasury, and it's huge. The raising of money through issuance of new securities, the cash sits there for a while, then we spend it. The other part is reserves, which are mostly about the banking industry. When the Fed is buying securities, reserves go up, bank deposits go up. When the Fed is letting their balance sheet run off, in other words, they're getting paid for those T-bills by the Treasury immediately has to issue a new bond, right? When that bond issued, owned by the Fed is redeemed, they go out and sell another bond. That makes bank deposits fall. So there's a one-to-one correlation between whether or not the Fed is buying securities or allowing their portfolio to run off, and whether or not you have reserves growing in the US, bank deposits growing in the US. Because obviously we don't see new lending unless we have more bank deposits. And right now, they're letting the book run off, so bank deposits have actually been flat to down for the past year. And again, this has a big impact on the economy. So the Fed has to navigate these two really big factors. One is Treasury cash. The other is just the amount of reserves they have in the system. And they have to make sure that they don't mess this up, because those are both two very big factors in the economy, factors in the financial world. And, they've gotten it wrong in the past because they weren't quite sure what the minimum was. And by the way, how do we model this? As a percent of GDP. Now, no amount of study of GDP is going to let you know if, in particular, we have enough liquidity in the system, particularly with smaller players. I'm not talking about JP Morgan or Wells Fargo. Those are little islands of cash. They don't even have to deal with other people. But for smaller dealers, funds, REITs, all of them, they're very sensitive to the amount of net liquidity in the system. And that's what I think the Fed is kind of playing chicken with right now.
And it's hard to know what that minimum is then.
Well, it's impossible to know because it involves so many different variables, so many different counterparties in the marketplace that you don't know on a given day whether or not the amount of reserves is adequate. And then there are other changes in the system, both inside the Fed and at the Treasury, that can change that analysis, Julia, in a matter of days. So it's very difficult for the Fed to get this right because the variables are essentially unknowable. They are so complicated and so big, and there's a velocity issue here too because of the money moving in and out of accounts, moving in and out of the Treasury and the Fed. It's extremely difficult for them to manage this for stability.
Yeah.
And that's really the issue.
Okay. So speaking of the Treasury, we have Scott Bessent.
Yes.
Do you think has he been left with a bit of a mess here from the prior Treasury?
Oh,
There's
yeah.
a lot of short-term paper issuance, and I've heard folks kind of talk about this, but if you have a take there, I would love to expand on it.
Well, look, it's very simple. Janet Yellen issued a lot of Treasury bills rather than trying to issue longer-term debt. She did this to keep the deficit down because obviously the cost of T-bills has historically been lower than the cost of long-term debt. Now, more recently, when the Fed raised interest rates, bills went up to 5%. The 30-year is still lower than that, although it's pretty close now, right? So it's that tendency to fund everything short-term that really is a problem. And what Scott Bessent said during his testimony is he'd like to see us issue more longer-term debt so we can balance the Treasury's cash needs and not have to go back to the market all the time for these big piles of new cash that they have to raise. It's $1 trillion every 4 months. So he did address it, but the question is, can we do it? Because the markets are not as keen on owning 30-year bonds as they are on owning T-bills. And part of this is just volatility. It's safer to be down at the low end of the curve than it is to be out there owning a lot of duration risk, right? So that's what he faces. It's a very complicated issue because members of Congress, depending on what day it is, are not necessarily going to help him. Members of Congress want candy to take home. They want to cut taxes. So, Bessent has to be, much like Steve Mnuchin was in Trump 1, the adult in the room. And he is surrounded by people who, frankly, I think are dangerous irresponsibles. All they care about is short term and, the midterm elections coming up. That's about as far as their thinking goes.
Yeah, so he has to make some difficult decisions for the long term. Quick question though, like what kind of appetite is there for the longer dated, treasuries? Like,
Mm.
is
It
that a
depends on the
worry?
coupon. If the
Mm.
coupon goes up enough, they'll buy it.
Okay.
But the answer is not much, Julia. The classic example of this is the red-haired child, the 20-year Treasury bond.
Mm-hmm.
Nobody wants 20s. There's no liquidity in that maturity. Will they buy 30s? Yes. And I think they would buy longer dated treasuries as well. We could probably go out to 50 years because dollar swaps are quoted out to 50. So I don't think that would be that difficult. But the sad thing about Yellen is I think she was totally over her head at Treasury. She wasn't really qualified for the job. And obviously during COVID, what should we have done? We should have issued long dated debt. And we missed that opportunity. But having said that, would we really want to saddle investors with 30-year Treasury bonds with a 2% coupon? No. Treasuries actually have been buying some of that old paper from 20 and 21 just to normalize the market so the dealers will buy and sell the securities. If you're a Treasury bond trader or at a broker dealer, do you want to go load up on a bunch of Ginnie Mae 2s and 30-year Treasury bonds with 2% coupons? No. A lot of risk.
Yeah.
And by the way, you're underwater because your cost of funds is 5. So that the liquidity issue that was created during COVID, both by the Fed and the Treasury's actions, is a problem because it has put some structural impediments into the marketplace that we did not need. And it's one of those unanticipated effects after the fact because people look at quantitative easing, they say, well, we provided a lot of cash. We financed forbearance for millions of consumers for 2 years. The mortgage industry made a lot of money at the time. Well, not now. Now we're in a desert. There's not much going on in mortgages because rates are high. And by the way, we pulled a couple of years worth of production into the present. So, the cup is empty for a couple of years. We're going to have to wait for people to, move for new jobs or die or whatever to get the portfolio to turn over again so that those homes will be available for other people to buy.
Yeah, like the mobility issue, people just aren't moving. It's like, why? Why would you?
Well, I have a 3, okay? The 3% mortgage we have subsidizes us living in New York.
Mm-hmm.
Look at it that way.
Yeah, that too. You mentioned at the top of this conversation, taxes were going to be the big thing for the Trump administration. How are you
Yes.
thinking about that side of the equation?
Well, I think clearly they want to keep the existing tax cuts that are going to come due, or at least reauthorize them. But then I think they want to go out and do some more because, again, the midterm election has begun. I think that, for example, they're looking at increasing the fees on Fannie Mae and Freddie Mac to as much as a point. That's going to raise the cost of credit for consumers, but they want to take that money and use it to pay for tax cuts. So this is the thinking in Washington, Julia.
Can you explain that?
Well, they hope to make money when they release Fannie Mae and Freddie Mac from government control.
Mm-hmm.
So they'll take that promise of cash and they'll use it to pay for tax cuts.
Oh, okay. Yeah.
Yes, this is Washington. Now, this makes no sense. They should be talking about raising revenue and frankly, not cutting taxes further. But, we're still in this kind of fantasy land atmosphere in Washington. This is typical after a presidential election. They want to do something that will endear them to voters. But, the markets may not cooperate. That's the interesting thing. Can you imagine if we had to go out and issue a lot of 10s and 30s to finance the federal budget deficit? Imagine if we had to do half of our refunding for the Treasury next quarter with long-dated paper. You know what would happen? Interest rates would go up a lot. You'd have a 6% handle on the 30-year bond.
Yeah.
And you'd probably have the 10-year somewhere in the 5s. So that's why Yellen issued all those T-bills. She didn't want to expose the real situation the Treasury was in, so they just issued a bunch of short-term debt.
Mm-hmm. Yeah, I'm looking at the 10-year right now. It's at 4.5 right now. But what would be the implications if you saw 5 or 6 handle?
Well, the banking industry would be insolvent. There's hundreds of banks and credit unions in this country that need to be taken over because of interest rate issues, since COVID. And if we actually had long-term rates go up that much, God, it would be really tough for the banks, and it would be very difficult for the Fed because, they own a lot of mortgage-backed securities and they're not going anywhere. They're not prepaying. So, much the same way that we talk about the fact that people are locked into their homes and they have really low mortgage rates, well, those mortgage-backed securities that the Fed owns are not going anywhere. They're trading like 20-year securities now. When they were created in 2021, they had a maturity of 1 year. So that's how much has changed in the marketplace. And unfortunately, when that happened, the price of those securities fell. So if you look at Bank of America today, they own $500 billion worth of mortgage securities, and they're underwater about 10, 15 points. So that's the issue for the banks and anybody else who owns those securities, by the way.
Mm-hmm. But okay, so right now though, the economy, I take it's pretty good, right?
Rocking.
It's
Well, there's
rocking.
lots of liquidity in the system.
But
You
it
don't
sounds
see
like,
anybody.
right, but while it's rocking, it sounds like there are some, you look under the hood, maybe there's some issues out there.
I think inflation is the biggest problem, which is it has hurt low-income families. It has hurt really everybody at the bottom of the scale who don't have the flexibility to absorb price increases. But then, you go into New York City and the more affluent communities are having a great time. So it's a tale of two cities. There's still a big chunk of people out there who didn't really recover from COVID and are working harder than they've ever worked. But at the same time, everybody's happy to see the markets buoyant and see job creation strong. If you're a Fed governor, you do not see in the jobs numbers a real pretext for cutting interest rates. That's the difficulty. And they also see other indicators of rising activity. So, the Fed, as I said before, they couldn't really punish the economy enough to slow inflation. And I think we're going to have to just live with it, Julia. Because again, the Fed's not worried about inflation or jobs. They're worried about keeping the Treasury bond market open.
Yeah. So we're going to have
That's
to
their priority.
live to learn with the higher levels of inflation.
Look, when you have this much debt and the need to refinance it constantly, it's hard to escape the inflation.
Yeah.
That's really the problem. And, people are going to use tariffs, I think, as an excuse for some of the price increases that we've seen. But to me, it's much more fundamental. Inflation is a monetary phenomenon,
right,
as we learned years ago.
So you need the higher levels of inflation to address your debt situation. That's the other part of it.
Yeah, but would we survive that? I don't think so. I think the wasting effects of inflation would cause a political crisis in this country. It would look like Argentina.
Oh, yikes.
It's ironic that President Milei is doing so well in Argentina, and we have the same issues we have to deal with in this country. But we don't have the leadership yet. You're going to have to see a real crisis in this country before we get serious leadership in Washington that wants to talk about deficits and things like that. We can't do it yet.
Do you think we'll see that crisis play out one of these days, with our debt situation?
Right now, what I'm expecting in terms of the near term is the Fed will eventually drop rates. They have to. There will be a little mini boomlet in terms of the economy and housing. And then I think we see the maxi reset in home prices in 27, 28. My friend Stan Middleman predicted that in the biography I published of him in September last year.
Yeah, what is it about? I think it was 2028. It was kind of the thought.
Misery on the eights.
Yeah, what does he look? Yeah, misery on the eights. Is it just what's that about?
There are long cycles in economic activity. I'm not really a believer in the business cycle, but I do believe that credit and the ebb and flow of human action are very real factors. And I think what Stan was saying is that it takes time for supply to catch up with demand in housing. So if you look down south where you live, Julia, if you look out in the west as well, southern half of the country, right? Huge amount of home building, huge amount of spec homes. Are they going to sell these homes? Well, they're built for a middle market customer. These are not starter homes for first-time home buyers who have an FHA mortgage. These are homes for the middle class. And so when they're overbuilt, yes, there will be a readjustment and we will see home prices fall. I don't know that we'll see that much home price relief on the bottom end of the scale because there's no supply. It's very difficult to build that house for that first-time home buyer and keep it under, say, $300,000, which is not even the average. I think the average is closer to 400 now.
Yeah.
So if you really are catering to that bottom quarter of the population, that's a couple $100,000 house. That's hard to build given the cost today.
Yeah. Oh, I just saw a breaking news headline I'll get you to react to. Trump names Treasury Secretary Scott Bessent acting head of the CFPB after firing Chopra.
Well, that makes sense. They needed, under the law that created the CFPB, in order to have an acting director, you have to have somebody who's been confirmed by the Senate. And so since Bessent has now been seated, he can act as, acting head of the agency. He could also appoint a deputy to run the place on a day-to-day basis. I think they're going to try and legislate the CFPB out of existence, or at least turn it into a commission structure like the SEC, which will largely thwart Elizabeth Warren's intentions. She wanted to set this up as kind of a vanguard to punish evil capitalists who are abusing consumers. And that's why she set up just a single director. It was meant to be political. Once you turn it into a commission structure, you're largely neuter the agency, and it will have to be more reasonable in the future. They've been terrible with the housing sector. With the last 4 years under Biden, the CFPB was just imposing fines left and right oftentimes for no reason. But, this is the politics of it. This is Elizabeth Warren's, love child. So it is what it is. But I think they're going to do that pretty quickly.
Yeah. Let me ask one more question before I let you go, because I know we are at time. I want to get your take on just more of the markets these days. I think you probably have some views on like the valuations and maybe where do you want to be right now, or what do you like? If you can share, what do you favor?
Well, my financials are pretty overvalued. I just put out a piece this morning about Ameriprise, which is one of the best performing fund managers, financial shops out there. But you look at it and you say to yourself, are the equity managers going to drive this up? Are the passive strategies going to drive this up further? I don't know that they will. I do think my group is pretty fully valued. And I think if you hear even a hint of concern about credit in the Q1 earnings, if you see anybody pre-release based on credit for Q1, then I think you're going to see the financials give up some ground. One of those names I write about a lot is Schwab. Schwab still hasn't been redeemed. They've been performing well, but they're really following everybody else in the group simply because they got kicked around a couple of years ago. So, to me, this whole period of the last year, 18 months in stocks has been largely about, irrational exuberance, and also equity managers need to go out and earn a living, so they allocate funds, right? But the passive strategies, I think, have been really pulling up stock valuations. When they go up, they buy more. And so it tends to have that self-reinforcing quality on the way up, but it also works that way on the way down. If we see a correction on the downside, all of these passive strategies will become big sellers of equities. And it'll be interesting to see how the market deals with that.
Yeah, the passive bid. That's a topic that's come up on this show. Before I let you go,
or the passive, they will sell dramatically because if you're the dealer that has to provide liquidity to an ETF, if you have to sell, you have to sell. That's it. And the question is, can they get a bid and maintain an orderly market? That's always been the big question with ETFs.
Yeah. Something Mike Green has brought up on this channel, and others like I think Bill Fleckenstein has also brought it up.
Well,
Harold
it's an
Bradley.
obvious structural issue,
Yeah.
When you don't worry about where the bid is on securities in days when there's stress in the markets, then I think you're missing something.
Mm-hmm. Well, Chris, we love having you on every single month. I look forward to it. Any parting thoughts before I let you go?
Well, it's going to be an interesting year. As I've written in Inflated, and I've written in the blog too, I liken Donald Trump to Andrew Jackson. I think he's going to be just as disruptive. I think he's going to try and do some things that are really going to surprise people. And buckle up is what I would tell you. And I say this as a conservative Republican.
How about as an investor, though? Is that a welcome thing, or just?
I'm not ready to go to cash yet, but I have been thinking about gold a lot.
Oh, gold. Okay.
Yeah, I think that, the funny time for cryptocurrencies and everything else may be over soon. And people may have to think about liquidity and being a little safer than they have been in the past several years. Because if you think about it, Julia, even going back to 2008, this system was shocked. You had a lot of people who were really deeply affected by what happened. Then we have 2020. We do it again. So there's a background of fear behind a lot of investor actions. And whether you look at credit, whether you look at many other areas, we still have dislocations in markets and in the data that make it almost impossible to figure out what's going on. So, for example, last year, remember we were worried about a recession? So
Hmm.
all the managers went in and bought corporate bonds, thinking that they could sell credit strategies to retail investors. So
Yep.
corporate bonds are as tight as they've ever been, and yet we don't worry about credit. It's fascinating. There's just, it's like we put all the data in a blender and turned it on, and we're supposed to figure out what's going to happen next based on this data. But I would submit that it's really not giving you a clear picture. So whether you're at the Fed or you're trying to do asset allocation for your clients, I think you have quite a quandary right now.
Yeah. Well, let us know when you buy gold, okay? Because we want to break that on this channel. So
Oh, I got a story to tell you soon. Just stay tuned on that one.
okay, I like stories. I was like, I have a little bit of gold over there. But Chris Whalen, it is always great to see you. Chris Whalen, chairman of Whalen Global Advisors, author of the Institutional Risk Analyst, and you have your upcoming book, Inflated. So folks, go ahead and can
Yes.
they pre-order that, Chris? They should go ahead and pre-order
Yeah,
it.
it's up on Amazon,
Yeah,
May 2025. My
yeah.
friends at Wiley, they've done a really great job. It's been a pleasure working with them.
I love it. Well, thanks again, as always. Always a pleasure to have you on. Thanks, Chris.
All right, Julia, thank you.